Good morning, welcome to the ADS Securities Markets Update. On Friday, we faced another piece of disturbing news just a few days after the Federal Reserve decisions and also the release of the GDP, which also significantly weakens the chances for a rate hike in September or by the Federal Reserve in September. The quarterly employment index slowed down significantly toward 0.2%, down from 0.7%, while it had been anticipated to decline slightly to slow down again toward 0.6% only. And this is the lowest wages increase on a record. And in the meantime, the Federal Reserve needs to wait at least for another quarter in order to confirm whether the current slowing down is temporary or not. The next release of this number, which is the employment index, will be on the 31st of October, which means that it will be again or come in after the Federal Reserve decision in September. After the GDP announcement and also the Federal Reserve decision the day before, the rate or the interest rate probability in the U.S. increased toward 55% in September. However, after the Friday's release data, the rate hike probability has collapsed to just 34%. Moreover, December's rate hike also probability has been revised even lower, or came in also declined towards 68%, down from the 77%, which was estimated before. The U.S. dollar index recovered also at the end of the session on Friday, and this was despite the negative news. And basically, this was because of one of the Federal Reserve members, which is Bullard, who said that we're in a good base to raise rates in September, despite of the bad news about the employment index. However, the U.S. dollar index continued to trade well above its 100-day moving average, which stands here around 96.40s, and closed the day almost unchanged, especially on Friday, which means also that at the same time that the positive outlook remains there, but at the same time we still have some pressure to the downside. Traders this week needs to watch about two levels. First of all, we need to watch the 97.50s, which remains intact since more than 2 weeks, and with no clear break above that resistance here. And also we had a fake breakout here, another one we will be watching this week. In addition to that, we have to watch the trend line resistance, which is on the short term, which basically stands right now at the 97.80s, but the major resistance or the major trendline resistance, which stand here, is at 98.50, which is likely to hold ahead of a busy week with many economic releases and events. As for today, and beginning with the Asian session, which came in with a little bit of negative news, especially from China. The most disappointing came in from China yesterday, this morning, the final manufacturing PMI has been revised even lower toward 47.8, down from 48.2, despite the fact that estimates were to rise again or to be revised up toward 48.3. As for the European session ahead, we will be watching the final manufacturing PMI from all over the Eurozone today, including the Spain, Switzerland, Italy, France, Germany, and the UK. But the most important release will be today from the UK, which is the manufacturing PMI. The estimates are to recover further toward, again, a 51.6, up from 51.4. This is for the month of July and June. In addition to that, going forward to the US session today, also there are many economic releases, and this is before going into the US, which is expected to go higher again, but it would be the same as almost last month. It would be the highest in almost 1 month only. As for the US session, we'll be waiting for many economic releases today, which is likely to have a notable impact on the market, especially if they come in also with further negative surprises. But we will be waiting for the core PCE price index, which may rise by only 0.1%. That's on month-over-month basis, but the year-over-year may come in at stable at 1.2%. In addition to that, we'll be waiting for personal income, personal spending, final manufacturing PMI, the ISM manufacturing PMI, and the construction spending, which likely also to have a notable impact on the market, especially again if they come in with many negative surprises or even positive surprises. This is it for today. You can follow us on our social media sites, Twitter, Facebook, and YouTube to get the latest economic releases, reports, and analysis. Thank you for watching. I'll see you once again tomorrow.